Expat US Tax explain difference between FATCA versus FBAR. FATCA is closely related to FBAR, but complying with FATCA is the responsibility of foreign financial institutions, such as banks, etc. FBAR is for individuals and FATCA is for financial organizations. The information being reported by the individual on their FBAR is very similar to the information being reported by the foreign bank. When a bank asks their customer to complete a W-9, that's the bank telling them that they're going to be reporting their banking information to their government, which then passes the information over to the US government. As an example, if you bank with the Commonwealth Bank of Australia, CBA, and they ask you for your SSN upon opening an account, or ask you to complete a W-9 if you're an existing account holder, they will then report parts of your banking information onto the Australian government, who will then pass it on to the US government. So, what do you need to tell them? Essentially, it's your basic account information, such the name of the bank, account number, account type, and also the names of any joint account holders. Beyond that, they want to know your highest balance in each account during the calendar year and if the account can earn interest. The balance of the account is not taxable, it's simply reporting the highest balance. The interest generated by the account should be on your US tax return, preferably along with a foreign tax credit, but that's for another article. Getting to know the FATCA legislation. The FATCA legislation was passed, or hidden, take your pick, as part of the HIRE Act and has to do with a series of legislative changes that the US government has made over the last 10 years. These legislative changes require that financial institutions that are based outside the US but hold accounts for US persons provide information concerning those accounts. This ensures that the US government can try to collect more tax revenue on income streams that are linked to accounts outside the country. In this context, US persons are more than just individual taxpayers. The Internal Revenue Service, IRS, describes a US person as follows. A citizen or resident of the United States. A domestic partnership. A domestic corporation. Any estate other than a foreign estate. Any trust in which a court within the United States can exercise primary supervision over the administration of the trust, and one or more U.S. persons have the authority to control all substantial decisions of the trust. Any other person that is not a foreign person. The FATCA rules were essentially developed to prevent tax evasion by U.S. persons with offshore financial assets and accounts. Part of the FATCA legislation requires that banks and brokerage firms outside the U.S. provide FATCA reports to the U.S. Treasury Department each year. These reports should confirm the balances held in those accounts for the U.S. people in question. For those a little less trusting of the official line will have no doubt considered the amount of information that the IRS will hold about the millions of U.S. citizens living abroad that have happily been under the radar, not filing their U.S. tax returns. Understanding the FBAR requirements. According to the IRS, the HIRE Act also contained legislation requiring U.S. persons to report, depending on the value, their foreign financial accounts and foreign assets. Separate from FATCA legislation, there is the Report of Foreign Bank and Financial Accounts, FBAR, which has its own set of requirements. The FBAR is the report that each U.S. person files with the U.S. Treasury Department to indicate the highest balances in their non-U.S. accounts each year. The eligibility to file these reports is determined by several factors. To file an FBAR, you must be a U.S. person or corporation with foreign financial accounts whose aggregate value is above $10,000 during the reportable year. For example, if you have two non-U.S. bank accounts, the first with a high balance of $8,000 and the second with a high balance of $3,000, then you're over the $10,000 threshold and you need to report every account, even accounts with a zero balance. It doesn't matter if you live paycheck to paycheck, right? Well, actually, it can. If you have one bank account with a high balance of $2,000 and a workplace retirement or pension account, such as superannuation, with a high balance of $9,000, then you've over the threshold and you need to report all non-US bank accounts. What if a person doesn't file their FBAR? What happens? U.S. taxpayers who do not provide the necessary reports or incur violations can be penalized by the IRS. Penalties can be either criminal or civil, monetary, depending on the offense. According to the IRS, assertion of penalties depends on facts and circumstances. In reality, we don't see many FBAR fines issues. The ones that have made the press usually involve millions of dollars. But, for any of you readers that think the IRS wouldn't have a chance in court, guess again. They've won almost every court case in and out of the United States. Think you're safe as a small fish. Be careful with that assumption. Small fish rarely have the endless resources to fight back. Do you really need to be worried about filing this form? For the far majority, no, just make sure you file it on time. It's easy to file yourself, for free. Here's an article about how to file your FBAR for free, written in layman's terms. What will they do with all this bank information? Today, not much is happening, not on the surface anyway. It would be a lazy assumption to think that the dragnet won't get pulled one day, and you know what they say about assumptions. The realists may say it will be pulled days after the temporary streamlined tax amnesty program is closed. Ultimately, the U.S. Treasury will have software in place to match these two reports over the long term. So, they will have the FATCA reports from the financial institutions and the FBAR reports from the U.S. persons with offshore accounts. In theory, these two reports should have the same information, just from different sources. If they have contradicting information, then that would be an opportunity for the IRS to send a notice and ask the U.S. taxpayer to explain. The IRS would also have the opportunity to charge additional tax on income linked to those accounts, depending on the discrepancy in the two reports. What will they do with all this bank information? If you want full peace of mind, use the IRS streamlined tax amnesty program to catch up on your U.S. tax and FBARs safely, without penalties. Clark Stott. Expat Tax Online, low-cost U.S. tax prep. Company name, Expat US Tax. Contact person name, Clark Stott. Email, info@expatustax.com. Office 701, Jumeirah Bay X3. Cluster X, JLT, PO Box 393672. Dubai, UAE. Telephone, +971, 4452, 3726.